The S&P has already delivered double-digit gains this year, up about 12%. But does the rally have more room to run? Carson Group thinks yes, projecting the index will finish the year as high as 18% up. Ryan Dietrich, Chief Market Strategist at the Carson Group, joins us now. Nice to see you, Ryan. All right, give me a sense right here. The Dow's holding up today, NASDAQ slightly lower, S&P off just a bit. Did you expect a bigger reaction to what Scott Besson had to say?
First of all, thanks for having me back, and I hope everyone celebrates National Waffle Day out there today. You think about it, no. I don't think we're overly shocked by that. I mean, today it looks like watching paint dry. I know chips are down a little bit more. I mean, as everyone said, NVIDIA earnings coming up. Obviously, Jackson Hole's coming up. Bottom line, getting a little technical for a second here. As long as we stay above the June 2nd peak, around 76.10 on the S&P 500, I think this is constructive, and we're just kind of catching our breath here.
All right, let's talk a little bit about the big picture here. You're overweight tech, financials, industrial, healthcare. Where are you seeing opportunity?
Well, those areas, I guess, specifically, and you think about it, like the economy, as probably other guests have pointed out, I mean, it looks like it's turning the corner to us. Those regional, surveys we saw last week are strong. We know we just had really good earnings season. I know the consumer, you can pick fits and starts there, but we've said a lot this year. This is an inflationary growth environment, meaning inflation is going to be a little hot. Yields might be a little bit higher, but the Fed's going to run it hot. And again, do we think being equities, overweight equities, underweight bonds still makes sense? We've said if you drop it, hit your foot and it hurts. Those are the things you want to have in that bucket to diversify your bond portfolio. But one of the other concepts we've talked about is kind of a barbelled approach, right? You don't have to be a hero. You don't have to have just all one thing. We're saying, hey, own some growth, own some value. We manage billions of dollars here at Carson Group. We're probably about 53% growth, 47% value. I feel pretty good with that because there's a lot of areas that very well could take the baton, like healthcare just did obviously last week with the incredible moves we saw.
All right. I'm looking at a chart that you sent over here that say, and it appears in your chart, you're not seeing anything overly concerning, even if there was a June peak for the S&P 500.
Mm-hmm. Well, that's correct. And again, we did have a June peak on June 2nd, but we went above that. No year in history has ever peaked in June. So history doesn't repeat itself, often rhymes, Mark Twain. We'll get a little more technical for a second. Just 2 days ago, 74% of all the components in the S&P 500 were above their 200-day moving average. You go back in history, when that's trending higher, that's usually a good sign. Now, eventually, you might have a peak. We could have some August, September volatility. Everyone knows midterm years. You historically can see that, but I think we kind of had that volatility ahead of time this midterm year, and we're still pretty optimistic we get through this week with Jackson Hole. One more thing on Jackson Hole, don't forget last year Jackson Hole market liked what I heard because the Fed back then said going to run it hot, and what really took off after Jackson Hole, that's when gold really got going. So we're looking at maybe another situation like that where the Fed says, hey, we don't think they're going to cut. I mean, we might be contrarian there. I'm sorry, hike. We don't think they're going to hike. We think they're still going to run it hot. You want to be in equities and maybe some gold and commodities in that situation.